Here's a number that should stop you cold. 90%. That is the percentage of individual investors who underperform a basic index fund over any given 10-year period. Not because they picked bad companies, not because they got unlucky, because they made the same completely avoidable mistakes that nobody warned them about before they started. This video is that warning. And if you are anywhere near the beginning of your investing journey, the next 20 minutes might be the most valuable 20 minutes you spend this year. Ray Dalio built Bridgewater Associates into the largest hedge fund on the planet by doing something almost nobody does. He studied every major financial crisis across 500 years of economic history, the crashes, the recovery, the patterns that repeat themselves with uncomfortable precision. And from all of that, he distilled a framework so clear and so logical that once you understand it, the stock market stops being terrifying and starts making complete sense. This video is the beginner's roadmap to investing in the stock market in 2026, built on that framework, designed for the specific environment we are in right now, and structured so that by the end of it, you will know exactly what to own, exactly what to avoid, and exactly how to build toward $1 million. Not by being lucky, but by understanding the machine everyone else is ignoring. But before we get into any of that, there is one thing you need to hear first, because the single most dangerous thing a beginner can do in 2026 is follow advice that was written for a world that no longer exists. For roughly 40 years, from around 1980 to 2020, the investing world operated inside what you could call the perfect tailwind era. Interest rates fell continuously for 4 decades, from 15% all the way down to basically zero. When rates fall, stock valuations go up. When rates fall, bond prices go up. When rates fall, borrowing gets cheap, companies expand, profits grow, and almost every conventional portfolio strategy quietly works without you having to think very hard about it. Buy index funds, hold for the long term. Stay diversified, buy every dip. All of it worked, not because those were particularly genius strategies, because the underlying environment made nearly everything work automatically, like a wind at your back you did not even know was there. That wind stopped. We are not in a catastrophe. The sky is not falling, but we are in a genuine transition. And transitions are where unprepared investors bleed money slowly and prepared investors build generational wealth while everyone else is confused about why their old playbook stopped working. The difference between those two groups almost always comes down to one thing: understanding the machine before putting money into it. And here's something that almost every beginner gets completely backwards. They start by asking which stock to buy. That is the wrong first question. The right first question is what kind of environment am I investing into, and what does that environment reward? Get that question right, and the specific instruments almost choose themselves. Get it wrong, and it does not matter how well you picked individual companies. You are rowing in the wrong direction. Think about what happened to Japanese investors in 1989. The Nikkei index peaked at 38,000 points. It was the most dynamic, innovative economy in the developed world. Companies were profitable, growth was real, and yet someone who invested in that market at the peak waited over 30 years to see their money recover in nominal terms. Over 30 years, not because the companies were bad, because the macro environment, the debt cycle, the demographic pressure, the policy response overpowered everything at the individual company level. Environment first, then instruments, always. So here is what the machine actually looks like. The economy runs on 3 forces. The first is productivity growth. Are people producing more value this year than last year? Is technology making workers more efficient? Are new industries creating output that did not exist before? When productivity grows, the economy expands in a healthy, sustainable way. This is the good kind of growth. The second force is the short-term debt cycle. This one repeats every 5 to 8 years. The economy heats up. People borrow money, they buy houses, cars, start businesses. Banks lend freely, things get hot. Central banks raise interest rates to cool everything down. Borrowing gets expensive. Spending slows, a recession follows, then rates come back down. The cycle resets and starts again. This is why recessions appear every 7 to 10 years. It looks random from the outside. It is not. It is the machine cycling through its natural rhythm. But here is the third force, the one that most beginner investors have never heard of, and the one that makes 2026 a genuinely unusual moment to be starting your investment journey. It is called the long-term debt cycle. And understanding it will immediately separate the way you think about money from the way almost everyone around you thinks about it. Over decades, debt accumulates across the entire economy. Government debt, corporate debt, consumer debt. Each short-term cycle adds a little more to the pile. Most of the time, that is manageable. The economy grows, incomes rise, and the debt stays at a level that can be serviced without too much strain. But every 75 to 100 years, that pile gets too big. The debt load becomes so heavy that it starts to crush the very growth it was supposed to fuel. And when that happens, the entire system has to restructure. Assets reprice, currencies weaken, and the strategies that worked brilliantly for the previous generation quietly stop working for the next one. The last time this happened in America was the 1930s and 40s. Right now, total government debt is over 125% of annual economic output. The government spends more than $1 trillion every single year on interest payments alone, not reducing what it owes, just the interest. More than defense spending, more than education spending, nor than education spending, just servicing existing debt. That is the environment you are starting your investment journey in. Not a reason to panic, but a reason to think carefully. Let me show you exactly what thinking carefully looks like through two people who started in the same era with real money on the line and ended up in completely different places. His name was Thomas, 51 years old, software engineer. 30 years of disciplined saving had built him a portfolio worth $1.4 million. He was 9 years from retirement and feeling genuinely good about where he was headed. His wife had already started looking at beach houses on the Carolina coast. They had a trip to Portugal booked for the following spring. Thomas had a financial advisor he trusted completely. That advisor put 60% of his money in stocks and 40% in treasury bonds, the classic allocation that had worked reliably for decades. When a few voices started warning that bond values would collapse if interest rates rose sharply, his advisor dismissed them. Bonds are safe, he said, government-backed, rock solid. Then 2022 happened. The Federal Reserve raised interest rates faster than it had in 40 years. And here is something most people do not fully understand about bonds. When interest rates go up, bond prices go down. Not a little, a lot. A 10-year Treasury bond loses roughly 10% of its value for every 1% rise in interest rates. Rates went up by more than 4% in 18 months. Thomas's bond portfolio, his safe, conservative advisor-recommended bond portfolio, lost over $200,000. The stocks fell too. By the end of it, his $1.4 million had become $900,000. He was 53. His retirement calculator now showed he was nearly $700,000 short of his goal. The Portugal trip got canceled. The beach house conversation stopped. Thomas pushed his retirement to 65, then 68. His wife stopped mentioning it altogether. The last time the story was revisited, Thomas was 62 and still working full-time. The Carolina coast was still a dream. The advisor who recommended the bond-heavy portfolio had retired comfortably at 58. That is not a story about bad luck. That is a story about following advice designed for a world that had already changed. And before you think Thomas was an unusual case, he was not. The 2022 bond collapse was the worst year for the traditional 60-40 portfolio in over a century. Pension funds, retirement accounts, conservative investors who had done everything right by conventional standards, all of them got hit simultaneously from both sides. Stocks fell. Bonds fell. The one scenario, the 60-40 model, was never designed to survive. How many people do you know who quietly stopped talking about retirement in 2022 and 2023? How many conversations went silent around that topic? That silence was not coincidence. It was the sound of millions of Thomas situations playing out across the country at the same time. The advisor industry's response: stay the course. It will recover. And for many people, it did eventually. But eventually does not help you. If you were planning to retire at 63 and you are now 64 and still 3 years away from being able to afford it. Now meet someone who understood what was changing. Her name was Priya. She was 29 years old when she started investing. She had no financial background, no special connections, no inheritance. She had $800 a month she could set aside after expenses, and 2 weeks of evenings she spent reading before she put a single dollar into the market. What she read about was debt cycles, about how the same patterns have repeated themselves across centuries of economic history, about how the investors who survived the hard transitions were never the ones who predicted the exact timing of the crash. They were the ones who built portfolios that did not require perfect timing to survive. Priya built 3 layers. The core was a broad market index fund, tracking the 500 largest companies in America. Not individual stocks, not a sector bet. The entire market in one instrument, with fees so low they barely registered. She put 60% of her monthly investment here and set it to auto-invest every single month without exception. Before explaining the rest of what Priya did, it is worth pausing on what an index fund actually is, because this is where a lot of beginners get tripped up by terminology. A mutual fund is when investors pool their money and pay a professional manager to actively select stocks he or she believes will outperform. That manager charges a fee, sometimes substantial, and that fee compounds against your returns year after year. An index fund does something entirely different. Instead of paying someone to make decisions, it simply mirrors an existing market index automatically. No manager, no active picking, just the market as it exists at a fraction of the cost. And the extraordinary thing, proven repeatedly over decades, is that this passive, no decisions approach outperforms the vast majority of professional stock pickers over any long time horizon. That is where Priya put 60% of her money every month. The second layer was short-term government securities, treasury bills with maturities of 3 months to 1 year, currently earning 4 to 5% with no meaningful risk of loss. This was not where Priya expected to build her fortune. It was her dry powder, her optionality. The cash she would deploy aggressively when the next correction arrived and everyone around her was panicking. When markets dropped sharply, Priya was not a victim. She was a buyer. While Thomas was calling his advisor in distress, Priya was moving her government securities into equity funds at prices that had been unimaginable 3 months earlier. The third layer was a small allocation to gold, not a bet on collapse, not a prediction about the future. Insurance against a scenario that repeats itself at the end of every long-term debt cycle. The one where governments print money to manage debt loads they can no longer service through growth alone. 5 to 10% of her portfolio. Set, forgotten. Just sitting there doing nothing useful in good times and protecting everything that mattered in bad ones. Here is something worth understanding about the psychological side of owning this kind of structure. Most investment portfolios feel like a single bet. You are either winning or losing depending on whether the market goes up or down today. Every headline becomes personal. Every dip feels like a direct attack on your future. And that feeling, that constant vulnerability, is what drives the emotional decisions that quietly destroy long-term returns. A layered portfolio feels different. When markets fall sharply, your index fund drops, but your government securities did not. Your gold allocation may have actually gone up. The overall damage is contained, and contained damage is psychologically manageable in a way that total exposure to a single outcome simply is not. This is not just about feeling better, it is about behavior. Investors who feel like they have some protection are dramatically less likely to make panic-driven decisions at market bottoms. And avoiding panic selling at market bottoms is worth more to your long-term returns than almost any other single factor. Rhea never panicked, not because she was unusually disciplined, because her structure made panic unnecessary. The outcome was already survivable across multiple scenarios. So the emotional pressure that destroyed Thomas never had the same grip on her. A decade after Priya started investing, her portfolio had grown to over $400,000, not from exceptional timing, not from picking the right companies, from consistency, a three-layer structure, and the emotional discipline to keep buying when everything felt wrong. Here is the math underneath that result, because it is important to see clearly. If you invest $500 every month into a broad market index fund, earning an average of 8% annually, after 35 years you accumulate well over $1 million. The S&P 500 has returned roughly 8 to 10% per year on average across the past 80 years. That figure includes the Great Depression, World War II, the stagflation of the 70s, the dot-com collapse, the 2008 financial crisis, the COVID crash. Through all of it, the long-term average held. And this is the part that gets quietly omitted when people quote that number 8 to 10% per year. Does not mean 8 to 10% every single year. Some years you are up 25%. Some years you are up 25%. Some years you are down 30%. And some stretches you go absolutely nowhere for what feels like forever. The 1970s demonstrated this in the most painful way possible. Someone who invested in the U.S. stock market in 1968 and checked back in 1981 found their portfolio essentially unchanged in dollar terms. And when you account for inflation running at 7 to 9% annually through that period, their actual purchasing power had been cut in half. 13 years. Patience and discipline quietly destroyed by the wrong environment and the wrong allocation. This is precisely why structure matters more than timing. The goal is not to find the one perfect asset. The goal is to build something that survives multiple possible futures. Inflationary environments, deflationary environments, fast growth and slow stagnation, without requiring you to predict which future arrives first. Most beginners never think about this. They open an account, buy whatever sounds most familiar, and then make emotional decisions every time the balance moves uncomfortably. The market drops 10% and they sell. The market recovers and they buy back and higher than they sold. The market drops again and they repeat the cycle in reverse. This is not stupidity. It is human nature operating exactly as designed, wired for immediate threat response in a situation that rewards the opposite behavior. The solution is not to fight your instincts every month. The solution is to build a system that makes the right behavior automatic so your instincts never get to override it. Here is what that system looks like in practice for a beginner starting today. Open a brokerage account with a reputable platform. If your employer offers a retirement account with any form of matching contribution, start there. That match is a guaranteed return before the market does anything at all. Make your first purchase into a broad market index fund that tracks the 500 largest American companies. Then set up automatic monthly contributions for an amount that is honest and sustainable, meaning an amount you will not need to touch, regardless of what the market does. This is the most important step, not the amount, the automaticity. The decision to remove the monthly decision entirely. Keep 15 to 20% of your total investable assets in short-term government securities. Your brokerage platform will have options for this. Roll them forward when they mature. You are earning 4 to 5% on your safety reserve while keeping it fully liquid. Allocate 5 to 10% to gold as an asset class, not individual mining companies, not leveraged instruments, a straightforward exposure to gold for your brokerage. Set the allocation. Do not watch the price daily. Let it function as the insurance it is designed to be. From that point, the system runs itself. Every market condition, every headline, rising markets, falling markets, sideways markets, keep contributing, keep the structure intact, keep going. One last thing worth addressing directly because it comes up constantly among people just starting out. The question of when to start. The most common reason people delay investing is that the market feels expensive. It is near all-time highs. Valuations look stretched. Surely it is smarter to wait for a pullback and get in cheaper. This reasoning feels logical. It is not. The S&P 500 spends roughly 8% of all trading days at all-time highs. That means new records are not rare events. They are a normal feature of a growing market. And historically, buying at an all-time high has produced returns that are statistically indistinguishable from buying on any other random day because markets at all-time highs tend to be followed by more all-time highs. More importantly, every year you wait is a year of compounding. You cannot recover. If you invest $100,000 today at 8% annually, in 30 years you have just over $1 million. If you wait 5 years to start, that same 100,000 becomes 730,000. The 5-year delay cost you nearly $300,000. Not from a crash, not from bad picks, from waiting for a moment that never felt quite right. The Behave the stock was 10 years ago on. The second best time is today. If you were just starting out, or if you've been sitting on the sidelines waiting for a moment that feels safer, drop a comment below. Tell us where you are in the process. Whether you have invested before or genuinely starting from zero. The conversations in the comments on these videos consistently surface questions and insights worth far more than anything in the video itself. And the community of people thinking through these same questions is larger than most people realize. The path to $1 million has never been a secret. It's never required special access or inherited advantages or perfect timing. It requires a framework for understanding the machine, a simple structure built to survive multiple possible futures, and the discipline to keep the system running when everything around you is encouraging you to abandon it. Dalio spent 50 years studying how the machine operates. You just spent the last 20 minutes getting the most important parts of it. The machine is ready whenever you are.